Well, greetings to all my investment clients. My name is Walter Measers, your wealth manager, CPA tax advisor. I'm recording this on Sunday, March 22nd. Pretty late. I think it's pushing 10:30 in the evening, but I wanted to get this video out to my clients just to keep you informed what we're thinking, what we're doing. Just quick reminder to all my clients, we are safely on shore, waiting for the storm to pass, meaning we're sitting U.S. Treasuries, protected. And that's really what I want to go over today in our weekly stock market recap, economic recap, March 22nd, YouTube edition. But as always, required disclosure. I just want to make sure that everybody reads this disclosure, especially anyone who is not a client and watching this video. This video is intended for my clients, anyone else watching. It's not intended as investment advice or a solicitation to buy or sell any securities. Please seek investment advice or any changes to your portfolio from your current investment advisor, or give me a call. I'd be more than happy to sit down, analyze your portfolio, how much risk you have, how much downside exposure you have. As everybody can see, the markets are really trending in the wrong direction. That's why we moved to the shore, watching the storm out at sea, meaning the stock market. And until it settles down, we're going to remain onshore, safe in U.S. Treasury. So at your leisure, please stop this video and read the full disclosure just to make sure that you understand this is not intended as investment advice. So, stock market recap. Where are the major indexes? All major U.S. indexes fell for fourth straight week of loss. So S&P 500 broke below the major long-term support level. Small cap stocks entered official correction territory. What does that mean? Meaning they lost more than 10%. Tech stocks led the decline. AI names hit hard. Dip buyers nowhere to be found this week, meaning buy the dip mentality. People are really getting concerned, not only stock market, geopolitical issues, which I'll go into briefly. Investor mood, very bearish right now. Majority of investors now pessimistic about the market outlook. Again, because of all the turmoil that is going on. Really, the geopolitical price of oil is driving markets down. So short term, just too risky to be out at sea. It's safe to be on shore. Boats docked, anchored, and that's the approach we're taking right now. What's driving the sell-off? Pretty much three forces hitting the market at the same time. Energy prices rising sharply due to Middle East conflict. Inflation refusing to come down. Rate cut hopes are fading. Trade policy uncertainty adding to investor anxiety. There's no single catalyst. It's really pretty much everything. What to watch going forward? Will the S&P hold its current technical support level? Any peace signal from Iran? Potential sharp bounce. Fed language on inflation. Any softening? Energy prices, direction of oil determines everything. Long-term investors, I still have the belief, it says stay disciplined, but don't panic. But what we're doing with our client portfolios is we are out of the market, safe and sound. Federal Reserve, again, they held rates. They did not lower or increase rates. There was talk of they potentially may increase rates because inflation, oil prices, they still held steady. Housing market, housing slowing sharply, big miss on new home sales. And again, that word affordability. The big one that's not talked about is if you buy a new home right now, the average home is $400,000. You're getting a whole lot. The biggest issue is what happens is property taxes get uncapped, I'm sorry. What does that mean? If somebody lived in a home for 20, 30 years, their property tax is relatively low. But once you uncap, meaning um, the city treasurer bases the new home that was purchased based on current values. And sometimes that property tax will almost double. I had a client last week in my office. They were looking at a home, I think $500,000, but when they found out what their property tax was going to be, meaning it would be uncapped, it was pushing $18,000 a year. And they said, there's no way we can afford that. So tons of issues with real estate. If anybody's thinking of buying a home right now, I would wait. Again, this is not a recommendation. Just experts are saying be patient. Real estate will most likely be some kind of pullback, reset, maybe in a year, this year, next year. Nobody knows for sure. Economic growth. Growth is slowing. Late 2020 GDP came in weak, actually negative. Consumer spending pullback, recession risk rising, not guaranteed, but rising. And again, the war's full impact on the economy not yet visible on data. The longer this war with Iran goes, the greater the probability of greater economic growth deterioration. The consumer squeeze, again, everything's going up. I talked about this. Wages did not keep up with cumulative inflation, which is for the last 3 years, probably 35 to 40%. There's no way wages kept up with that type of inflation. At best, 5 to 10% increase. So there's a huge gap. Jobs and labor market, especially Detroit metro area, it is really getting concerning, especially with the automotive sector. The They bet huge on electrical vehicles. Those are not selling, so they're retooling. Kind of also AI is having a huge impact on this. The big picture, the Fed cannot cut and fight inflation simultaneously. War adds inflation. And I'll talk about, kind of the transitory inflation, slow growth demands stimulus. So this is kind of a definition of stagflation risk. Last time we faced this was in the 1970s. It was painful. Not saying we are going into stagflation. U.S.-Iran war, how we got there, I'm not going to go into this. You want to stop the video and read it at your leisure. But at this point, the key risk, no peace talks. Iran insists that the strait stays closed. Every weekend is a wild card. So pretty much Iran is refusing to budge. They're threatening more strikes on Israel and other neighboring Arabic countries. That causes, instability and geopolitical risk. What does that mean? Market is going to continue to trend down. Again, I don't want to go into all these geopolitical, there's the U.S.-Iran war, U.S.-Russia, Ukraine, China, Asia tariffs, Europe energy political stress, the layered shock problem. And again, at your leisure, if you want to deep dive into this. At this point, I say, you know what? It is what it is. So just kind of high level U.S.-Iran war critical. Russia-Ukraine high, China-Taiwan elevated, U.S. tariffs high, Europe energy high. What does that all mean? The market hates uncertainty, and all these issues that's why we see the market pullback. Is it the start of a major pullback? Nobody knows for sure, but the probability is getting higher and higher that some kind of major reset in the stock market, in real estate. Everything is a bubble right now territory. So what does that mean? To get back to historical norms, there's got to be a reset or a pullback. Let's talk about one of my clients asked, is it time to get into long duration bonds? And the answer is not yet. Absolutely not. Kind of bonds 101 basics, and I keep talking about interest rates, which direction they're heading. I'll show you on the chart at the end of the video. It's heading in the wrong direction. So bond prices and interest rates move in opposite directions. When rates go up, bond prices go down. The longer the bond maturity, the bigger the price drop if uh, interest rates go up. Think of it like a seesaw. Rates up, bond values down. This is why long duration bonds have been painful this year. Why are yields going up? War in Middle East, pushing energy prices. So fear of inflation or transitory inflation, high energy, high inflation expectations, Fed holding rates firm, no relief in sight. Bond investors demanding more yield to offset inflation risk. Yield curve steepening, historically a warning sign. Um, Bonds as a safe haven tested. Normally in a crisis, investors run to bonds for safety. But this crisis is inflationary, so bonds are not the place to be, because unfortunately, what long duration bonds are pointing to is potentially short term higher interest rates. How are we positioned with our clients? We are definitely not in long duration. We are in short term 1 to 3 month US Treasury bills. We moved in there in February, so short term bills nearly unaffected by rising long rates. Capital preserved while long bonds fell. So we favor short term exposure 1 to 3 months, and we use ETF BIL, which achieves that. So it's a temporary. What I like to compare the US Treasury bills is we are on shore right now, watching the storm, and then when we get back on the lake or the ocean with our boats, meaning back to the stock market, really depends which direction the market is going to go. At this point, there's no definite probability, but the probability is pointing more and more to further downside, unfortunately. Inflation. Friedman's famous Friedman law versus it's transitory. So the word transitory argument, what's the key argument? Inflation is caused by one-time supply disruptions. COVID shutdown was a good example. Factories, goods became scarce. So what happened in COVID? Goods were scarce, and the government directly increased money supply, meaning they gave people tons of money. They were paying people not to work. What does that happen? There was less goods and services being produced. Natural disasters, transitory shock, pretty much supply shock. If you're paying people not to work, they're not going to produce. Fundamentals of economics, prices are going to go up. The risk of this if you're wrong, inflation gets embedded in wages. So if this is not transitory, then yeah, if it continues long term, and again, my humble opinion, I tend to agree with Friedman, who got a Nobel Prize in economics for this position. He says inflation, longer term inflation, is always a monetary phenomenon, meaning too much money chasing too few goods. Always. It's historical facts. Bear that out. Now, short term, yes, there could be inflation caused by supply shock, meaning oil. Right now, we're seeing that supply shock in oil, again, driving prices up because oil is used for production almost in everything in goods and services production. So naturally, short term prices are going to go up. That puts fear into the market. And lo and behold, that's where you see the markets correct. What is it? Now, you've probably heard private credit, the hidden risk in your portfolio. What is private credit? It's non-bank companies lending money to businesses, largely outside normal bank regulation. Grew to trillions in assets after 2008 as banks pulled back, now showing stress signs. When we say trillions, we're talking over $3 trillion of this, what we call private credit. What is private credit? It's meaning um, these are non-banks, non-regulated that are issuing loans to corporations. And who's buying those? Annuity companies, pension funds. So there's the risk because, well, how does that affect me? I don't have any private credit, but you may have an annuity. You may have a pension. And pension funds pretty much were looking for yield. So private credit was the perfect choice initially, um, because everybody was chasing, better rate of return. What does that mean? High yield, private credit. If you're chasing yield, you're also increasing risk. So there is some risk exposure, and more of these private credit uh, hidden, call them banks, unregulated banks, lending companies, are at risk. You hear more and more in news that people are asking for their money back, and that creates what we call liquidity trap. Some are saying, well, no, you can't have your money back because we don't have the funds. We'd have to liquidate positions, which would be negative, and it's kind of a domino effect. So private credit is kind of the canary in the mine right now. That's really creating some concern in the market. Is it a systemic risk at this point? Hard to say, but it's definitely heading in that direction. So it creates a tremendous amount of risk, and the stock market is looking at that. So I don't want to dwell too much on private credit. Just be aware that it's out there and it's potentially could become very, very problematic to the stock market and also to banks who have exposure to this private credit. The markets, I like to say, they're almost as a casino. Emotion versus fundamentals. So, why markets feel like a casino now? Short-term prices driven by fear headlines. In other words, fear of missing out. People are just chasing returns, paying. They don't care what the price is. AI was a good example. Nvidia. Everybody's just chasing because they saw price go up. It's oh my God, I'm going to miss out. Fear of missing out. So nothing about fundamentals. They didn't care about what the price was. All they saw was trend was going. So it's an emotional driven upside to the market. Investors betting on, will the war end this weekend? Will the Fed link? Will Trump tweet something? These are unpredictable, and you can't analyze, balance sheets, the fundamentals. This is the casino motion. Sets the price in short run. So momentum. Right now, that emotional momentum is really dipping. That's why the markets are coming down. Fundamental versus technical analysis. Fundamental, what does that mean? You're looking at balance sheet, how healthy is cash flow healthy, profitability of the company. You can throw that out the window right now, short term, because that really doesn't matter. It's emotions. So technical analysis is for a short term analysis. Where is the crowd likely to take the price based on price patterns, momentum, support, resistance levels? In a casino market, technicals win the short term game. So, I used to follow more fundamentals, but I'm finding out you can't, even if you research a company and they have great fundamentals, so right now it doesn't matter. because the emotional side is taking over. So I'm not going to go into more detailed technical analysis, key signals for the current market. You know, these are probabilities, and I don't want to speculate. Nobody knows what the market is going to do over the next, month, 2, 6 months, 12 months. The only thing I can say, the probability of some major reset pullback is getting higher and higher and higher. Summary of our client positions as of March. So we pretty much are out of the market. As I mentioned, we're sitting safe in short-term bonds. So markets are reacting to geopolitics, inflation, the economy slowed down. What are the bonds doing? And the two big ones that I feel are geopolitical concerns, private credit, and direction of inflation will pretty much drive which direction this market is going to go. So again, short-term direction driven by emotion and not earnings or fundamentals. So keep that in mind. That's why we are out of the market. So our clients versus the S&P 500 year to date. On average, the S&P 500 year to date is down about 7%. So if somebody's holding $1 million portfolio, they would have lost 70,000. Now our clients year to date, we are up, depending 3 to 4%. So let's split the difference, 3.5%. That means on average, our clients are up 3.5%. Again, this is not prediction of future what we may do. Historical performance is no guarantee of future performance, but we are sitting safe and sound in short-term U.S. Treasuries. So getting back to this, that means we are 10% better than the S&P 500. Or if you want to look at it the way, rather than being down 70,000, we're up 35. So if we take the loss into consideration, we are up doing better than the market dollar-wise by 135,000. That's pretty significant. So I want to go into more detail of why managing drawdowns matters more than chasing returns. And I'm going to keep pounding this because that is my belief. And let me show you why is that critical. The math of drawdowns, why avoiding losses is more important and more powerful than chasing gains. So if you lose 10%, you only need 11% to recover. And you can read this at your leisure. So I want to go to, if you lose 50%, then you need 100% rate of return to recover. Notice what happens if you increase your loss from 50 to 60. You need 150% to recover. And you say, well, Walter, how often does that happen? Well, in the last, since 2000 to 2022, we've had 3 major pullbacks. Some were, 2 of them, 07, 09, and 2000 were approaching 60%. And during COVID, it was pushing 40. So it does happen more often than we think. And a correction is a 10% pullback. That happens usually on average 2 to 3 years. So it's more often than we think. And I want to talk about bond price sensitivity. So I want to give, sorry, I made a mistake. Oh no, $1 million. Somebody holding $1 million 30-year bond. What's the risk? Meaning if interest rates go either up or down. So again, remember, interest rates going up. If you're holding long duration bonds, the value will go down. And then if interest rates are going down, the bond value will go up. So let's use, currently the 30-year bond is is around almost 5%. So what if that rate of change increased by 3%? So going from 5 to 8, is that possible? Anything's possible. So the bond market value would drop to 662,000, so losing 337,733, or 33.8% loss. If it goes by interest rates increase by 2%, again, that's a gain. It's a loss of 248,000 or 24.8%. And even if it goes up by 1%, you're still losing 137,000 or 13.8%. So we don't want to be right now in bonds, because the probability that interest rates are going to probably stay around here or potentially even go higher, the risk is there. But what happens if interest rates now go down? So current is 5%, goes down by 1%, you gain 172,000 or 17.3%. Goes down by 2%, you gain 392,000 or almost 39%. Goes down by 3, you've gained 671,000 or a 67% gain. Again, so the potential, and this is going to happen at some point. That's why I keep talking about the long duration bonds is going to be amazing opportunity. Maybe in 6 months, 12 months, I have no clue. But once we see the trend that interest rates are going to go down, that will be the time for us to get into either 20, longer 20 to 30-year bond. We are not going to hold the bond for 20 or 30 years. That's the first question people ask. No, the holding period may be 2, 3, 4 months as interest rates continue to go down, and then we sell and make an amazing profit. So stay tuned on that. It's still not time to get into long duration bonds. You can stop the video and kind of look at, what within the next 6 months, the probability, what may be a good asset class to get into. 6 to 12 month probability. Again, these are probabilities. Nobody knows for sure. My personal opinion is long duration bonds will create amazing potential for making money for my clients, and eventually gold. But we just have to wait at this point. So let me just go into, sorry, I thought I had this up. Yeah, interest rates. So visually, I want to show you why we're not going into long duration bonds. This is a 30-year bond. Right now it's almost hovering around, call it 5%. So as you can see, let's look at 6 months. It's been kind of treading water, went down, and now it's trending up. Year to date, same thing, went down, trending up. It makes sense because of Iran. If we look at 5 years, again, it's been kind of trending up. There's no clear direction. Is it going to go to 6%? I have no clue. And then if we look at all, this is what we eventually want to see in long duration bonds. And what's going to cause long interest rates to go down? Once the oil shock is under control, meaning the Iran war ends, then interest rates will start to come down. The transitory inflation, as I call it, will probably go away, and that may be a potential for considering long duration bonds. And the same thing with gold. At some point, it's going to be an amazing opportunity to get into that. I just can't tell you if it's in 2 months, 3 months, or 1 year. again, getting back right now, we are sitting um, on the shore watching the storm, meaning we're out of the market, sitting in US Treasuries, printing around 3.5% right now. Short-term rates did come down. And that is right now the best place to be. So again, thank you for watching. Hopefully you enjoyed this video. I know it was a little bit longer than usual, but I wanted to make that point of right now that it is the best time to be on the sidelines, on land, and also the long duration bonds and what's causing inflation. Thank you for watching, and stay tuned to next week's stock market recap. Have a great week. Take care. Bye now.